Is a high dividend yield a sign that you found a gem, or is it just another rock in the pile? Sometimes you are looking for passive income, and stocks with high dividend yield can be deceiving. I found one recently that sparkled on the surface, but deep down had a lot of flaws. All right, so that company is BCE or Bell Canada. Now, Bell is Canada's largest telecommunications company. The dividend is usually somewhere between 6 and 7%. Recently, that's climbed to over 8%, and that's where it kind of caught my eye. So it's known for a consistent dividend and is popular with investors. But it does have a payout ratio between 80 to 90%. Some sources are saying upwards to 150%. That leaves little or no growth for the dividend over time. Now, some of the positives for Bell Canada are telecommunications is fairly stable in Canada and relatively recession resistant. Bell has invested heavily in technology. Now, is it a growth or is it a yield stock? Well, currently Bell is a high yield stock, but the payout ratio suggests it is unsustainable, which could see a cut to the future dividend. The payout ratio is well over 60%, tells us that there is very little growth opportunity. So at this point, it may be neither. In addition, the stock has been dropping, leaving little hope for capital appreciation. But will that change in the future? So just a few stats that you may want to consider if you're looking at Bell Canada as one of your options. The price for earnings is around 20 to 22, so neither over or undervalued, which is normal for a mature telecom company. The price per book is 3 to 4, which tells us investors are paying a premium for the assets. And again, this can be normal for utility sector type of stocks. Debt to equity is high, around 1.5 to 2.0, which, when you have high debt, can be a risk if interest rates are rising. Now, fortunately for Bell, Bank of Canada has just made a major cut. So maybe this will help them change their perspective and pay off a little debt faster and have a little more room to grow. Return on equity is between 15 and 18%, suggesting equity is well managed for profitability. So, in that sense, you can maybe rely on the fact that the company is being managed properly, and potentially going forward they will be able to kind of redirect the ship here and make it profitable or increasing in profit, and also hopefully grow and expand the dividend. Free cash flow is substantial and key for maintaining consistent dividends. So fortunately, Bell does have a lot of free cash flow, which will hopefully help them maintain their dividend. Some of the red flags you may want to look at if you're getting into BCE: a high payout ratio, high debt levels, limited growth potential. In addition, recent job cuts suggest cash flow may be at risk. This may be relieved by recent rate cuts by the Bank of Canada, which I've already touched on. Now, I'm with WealthSimple. I use WealthSimple. They're not a sponsor here, but I feel like anybody who's new who is looking for an online broker might want to look at Wealthsimple. I do have a link below. Whatever reward I get, you get the same reward. Now, here's the thing: it's easy to use, and I don't pay any fees on just using it, and I don't pay any fees on any stocks that I buy and sell when they're Canadian stocks. Now, if you're new, this one is very easy to use, and I would recommend it for somebody who is kind of starting out. All right. So my conclusion on BCE Bell Canada is I'm definitely drawn into it because it's had a recent drop in price. And so that drop in price is attractive. The dividend is, well, quite attractive right now. So it does look like, you know, it's a diamond in the rough, but is there too much rough? And in that respect, I'm kind of like, is Bell going to be able to dig themselves out of this? And with kind of a little bit of a mixed bag on the position they're in, whether or not they're going to be able to sustain that dividend or not is yet to be seen. And with such high debt levels, are they really putting themselves in a good position? So, do they get out of that or do they not? So, there's a lot of question marks. And I feel like it's something that I'm interested in. I'm going to keep my eye on, but it might be something I want to hold off on. Now, this is a good time to let you know my disclaimer: I'm not an advisor. So, if you are looking at using this information for your portfolio, please do your own research, make sure it fits for what you're looking for, or see a professional advisor so they can help you determine what is right for you. And you want to make sure you're growing your portfolio the right way. All right, so that's it for today. Thanks for joining me. We'll see you on my next stock review and have a great day. See you next time.